Hi all, I'm Jeff Jr. And as we know, 2020 has been a year for the history books, with COVID-19 fueling current domestic and worldwide economic conditions. This has resulted in one of the deepest but shortest equity bear markets in history, believe it or not. In this week's video, I'll be covering a summary of our current economy, as well as where we see it heading for the rest of 2020 and even beyond. This video is going to be brief, and for more information you can refer to our free 2020-2021 market guide. So stay tuned to the end for more details on that. While efforts are still underway to develop a vaccine and effective treatment for COVID-19, early results are promising and have contributed to the quick rebound. Although the ultimate impact of the virus cannot be measured, there are some historical guidelines that can suggest a picture of what the next few years just might look like. Just look at the Spanish flu pandemic of 1918. That flu infected an estimated 500 million people worldwide. By 1922, economic recovery became evident, and government fiscal action soon led to huge growth and resulted in the Roaring Twenties. The 2020 bear market is unique in that it was brought on by the pandemic and coincided with the start of the recession. Just as quickly as it began, the markets began to rebound, spurred on by a massive fiscal and monetary stimulus provided by the Federal Reserve and Congress. In this specific market, the S&P 500, it took only 5 months to recover to its previous highs, despite a drop in GDP of over 30%. This was the sharpest drop in economic activity since the Great Depression. Now, I'm sure you want the answer to the question that we've all been asking, which is, what's next? The way I see it, there are two possible conclusions to COVID-19. Either the development of a vaccine, or just simple herd immunity which eradicates it. Until then, individuals, businesses, local and state governments wait to see if the government will provide additional stimulus this year, and perhaps even next year. So far, Congress's primary response to the current pandemic has been the CARES Act, which was enacted in March of this year. The $1.8 trillion direct relief package became the largest in U.S. history. The pace of this recovery moving forward will be heavily dependent on the behavior of the virus. Keep in mind that this is also a presidential election year, and come November, the future direction of the economy will be completely dependent on which party is in the White House and which party or parties control Congress. Looking forward to the 2020 election, the consensus is that 4 more years with the current administration will be the most favorable for the economy and the markets. While that may be the case, we should remember that market performance has been positive under both Democrat and Republican administrations. Now, while the media uses the presidential race to speculate on the stock market's performance, investors shouldn't get caught up in the speculation because, frankly, at this point, that's all it is. One of the most widely followed indicators of a company's value is its price-to-earnings ratio. This measures the current price of a stock relative to its earnings over the past 12 months or its expected earnings for the next 12 months. One phenomenon that has occurred because of the rebound in stock prices is that PE ratios for most companies have expanded. Historically, this has meant that future returns will be lower until earnings catch up with valuations. Now, given the strong returns that we've seen over the past few years, it would not come as a surprise that the returns will be lower for some time while valuations readjust to those historical norms. Now, that does not mean that investors should not be invested. Even during periods of PE contraction, returns are still generally positive. Another way for the markets to adjust is for the U.S. economy to rebound sharply and earnings growth to accelerate, reverting to the historical average. While company earnings are expected to be similar during Q4 of 2020 as they were in Q3 of 2020, the S&P 500 may provide strong returns in 2021. I personally am optimistic. 4 things to watch going forward include, number 1, are world economies growing? I personally think that they are. Number 2, is U.S. unemployment dropping and incomes growing? Yes, it is. Number 3, is the pandemic subsiding as treatments and a vaccine become available? It depends on your political view, but in my case, yes, I do believe it is subsiding. Lastly, number 4, what additional fiscal and monetary stimulus will be used to support the economy? That I just don't know. It's a continuous back and forth. In addition to the market volatility surrounding COVID-19 and the 2020 election, we cannot ignore other risk factors when planning for retirement. These are factors such as longevity risk, tax rate increases or lower benefits, and sequence of return risk. If you want more information, download our free 2020 and 2021 market guide. There we go into more depth on all that we've covered in this video to help you better prepare yourself for the future. Do you also know somebody who has those concerns? Send them the link. Hopefully they'll read it. It'll be in this description of this video. Although all this turbulence and unknown, patience and focus are key. It always has been. Panic decisions can have drastic consequences on your long-term financial well-being. Trajan Wealth is here to offer support and to be your ally. We share practical, individualized strategies with our clients so that they can prepare themselves against the worst impacts of recessions, both when it comes to investments and their lifestyle. Client or not, simply give us a call. Our fiduciary advisors are happy to help guide you through your investments, or if nothing else, give you a second opinion on your current investment strategies. So, until next time, I'm Jeff Jr. Take care.